Welcome to the Deep Dive, where we cut through the noise and give you the essential insights on the topics shaping our world. Today, we're plunging into a subject that isn't just buzzworthy, but fundamentally reshaping an entire industry: agentic AI in financial services. Okay, let's unpack this. Imagine a world where AI doesn't just answer your questions, but proactively acts on your behalf, making decisions, executing tasks, and learning along the way. That's the fascinating realm of agentic AI, and it's already transforming financial services as we speak. Our mission today, through this deep dive into a rich stack of sources, is to clarify what agentic AI truly is, showcase where it's already delivering incredible results, and critically explore the significant hurdles and strategic shifts required to harness its power responsibly. Get ready for some surprising facts and real-world examples that might just change how you think about your bank.
What's fascinating here is that the financial sector is, without a doubt, undergoing a profound and necessary shift. We're moving beyond the traditional, often reactive nature of earlier AI to something entirely different. Agentic AI is a form of autonomous intelligence capable of independent decision-making and execution across incredibly complex workflows. This isn't just an incremental upgrade to existing systems, it's a fundamental re-architecting of how financial institutions operate. And, well, it impacts everything from the detection of sophisticated fraud schemes to the very way your personal banking experience is delivered. The core insight here is that this technology promises not just efficiency, but opens up a whole new frontier of both risks and opportunities, which is precisely why understanding it deeply right now is so crucial for anyone in or interacting with the financial world. It's about more than just automation, it's about autonomous action.
So before we dive into the how, let's really clarify the what. Agentic AI, it certainly sounds like something from a sci-fi novel, but the material we've explored makes it clear it's very much a present-day reality. How would you describe this new breed of AI and what truly sets it apart from what we've seen before?
You're right, the name itself sparks the imagination, doesn't it? But to be clear, at its core, Agentic AI refers to an advanced class of artificial intelligence systems that possess a significant degree of autonomy. Think of it as a fundamental shift. Unlike previous forms of AI that primarily responded to prompts or followed rigid scripts, agentic AI systems are designed to independently and proactively perceive their environment, reason through complex problems, formulate multi-step plans, and execute actions to achieve predefined high-level goals with minimal human supervision.
Right, minimal supervision. That's the key difference.
Exactly. This is the crucial distinction. We're moving from mere automation to true autonomy. It's not just doing what it's told, it's figuring out how to achieve an objective.
Okay, so what are the characteristics that make it agentic?
Good question. To break that down, agentic AI has several key characteristics. First, there's autonomy and proactivity. These systems embody the capacity for independent action. Instead of waiting for a human command, an agentic system can initiate tasks based on its understanding of a desired outcome and its perception of the environment. It doesn't need constant intervention. It acts to achieve its objective.
So it takes initiative.
Precisely. Second, we see adaptability and learning. The financial landscape, as we know, is incredibly dynamic. Agentic systems are built for this reality. They learn from continuous feedback loops, market fluctuations, new data streams. This allows them to constantly refine their strategies and improve performance over time. They aren't brittle like traditional rule-based systems. They can adapt to changing conditions.
Much more resilient, then.
Much more. Finally, and crucially, they exhibit goal-oriented reasoning. A defining feature is their focus on achieving a specified objective, rather than just executing a pre-programmed sequence. Given a high-level goal, like minimize credit risk in the mortgage portfolio, and the agent can break that problem down into subtasks, develop a plan, and execute it using sophisticated reasoning, often powered by large language models or LLMs to navigate complex, multi-step workflows.
Interesting. So how does that work in practice? What's the sort of operational cycle?
Right. The operational cycle of an agent is quite fascinating and iterative, almost like a continuous loop. It begins with perception. The agent actively collects data from its environment, think APIs, internal databases, external market feeds, even user interactions.
Just gathering the info.
Exactly. Then comes reasoning, where it uses technologies like LLMs and natural language processing to interpret this data, understand its context, and identify patterns. Based on this, it moves to goal setting and decision making, evaluating multiple possible actions and selecting the optimal one based on factors like efficiency and predicted outcomes. The agent then proceeds to execution, interacting with external systems via APIs or other tools to carry out its chosen action.
So it actually does things.
It does things. And finally, it enters a critical learning and adaptation phase. It evaluates the outcome of its action and, using that feedback, perhaps through reinforcement learning, refines its future strategies. Now, to manage all of this, especially when you have many agents, this entire process is coordinated by an AI orchestration layer. Think of this orchestration layer as the control tower for all these agents. It's making sure data flows smoothly, that if one agent hits a snag, it knows how to handle it, and most importantly, it coordinates dozens or even thousands of agents so they work together seamlessly, like a highly intelligent, well-oiled machine. But here's a crucial point. The profound implication here is that while older automation focused on process failure, Agentic AI introduces the risk of judgment failure, the agent making a poor or harmful decision. This means governance must now audit the AI's reasoning process itself, bringing risk, compliance, and legal experts into the design and monitoring from day one.
That's a huge shift in thinking for governance. Okay, that's a great breakdown of what's under the hood. It sounds incredibly powerful, but we've certainly heard a lot of AI buzzwords over the years. I'm curious, how is agentic AI truly different from, say, the generative AI we've all been playing with to create text or images, or even robotic process automation, RPA, which has been around for a while in finance? Where do the lines get drawn?
That's a crucial distinction because the terms are often used interchangeably, leading to a lot of confusion. Let's start with agentic AI versus generative AI. Generative AI models, like ChatGPT, are primarily designed to create novel content, whether it's text, images, or code based on a user's prompt. They are essentially creative and analytical tools. Agentic AI, on the other hand, is designed to act.
To act, yes.
While it can certainly use generative AI as a tool within its broader framework for autonomous action goal achievement, it's not the same thing. Think of it this way. A generative AI might draft a persuasive email for you based on a prompt. An agentic AI, however, could be given the goal of resolve customer complaint. It would then identify the customer, use generative AI to draft a personalized email, access the CRM system to send it, and then monitor the customer's response to determine the next best step, perhaps escalating it to a human if the issue isn't resolved.
So the Gen AI is a component, but the agentic AI is the one driving the whole process.
Exactly. The Gen AI is a powerful component, but the agentic AI is the orchestrator of action, the one driving the workflow. Now, the distinction between agentic AI and robotic process automation, RPA, is even more fundamental. While both automate tasks, their capabilities and underlying logic are vastly different. Well, when it comes to logic and flexibility, RPA is deterministic and purely rule-based. It's an instruction follower, meaning it executes a rigid, predefined script of human actions, like clicking buttons or copying data. It's like a train on a fixed track.
Okay, very linear.
Very. Agentic AI is dynamic and goal-driven. It's an outcome pursuer that uses reasoning and problem-solving to navigate complex, unpredictable scenarios to achieve an objective. It's more like a GPS rerouting due to unexpected traffic. It adapts to achieve the destination.
Got it. That makes sense.
And this leads to profound differences in adaptability and resilience. RPA systems are notoriously brittle. A minor change to a user interface can break the automation, requiring manual intervention. Agentic AI, leveraging machine learning and a deeper contextual understanding, is designed to be adaptable. It learns from changes, handles variability, and can often recover gracefully from unexpected changes, making it far more resilient in dynamic enterprise environments.
So less likely to just break.
Much less likely. The scope of automation also differs significantly. RPA excels at automating discrete, repetitive microtasks, focusing on task-level efficiency. Agentic AI operates at a much higher level, capable of orchestrating entire end-to-end business processes and workflows. It can coordinate multiple systems, manage exceptions, and make decisions across an entire process, moving from mere task automation to true workflow autonomy.
Workflow autonomy, that sounds powerful.
It is. Finally, in terms of intelligence and context, RPA executes tasks without any real understanding of the underlying data or business context. An agentic AI, by contrast, leverages contextual understanding to make smarter, more nuanced decisions. An RPA bot might escalate a customer support ticket based on a simple keyword match. An agentic system, however, could analyze the customer's sentiment, their past interaction history, and their account value to determine the true urgency and the optimal escalation path. It's about intelligent contextual action, not just rote execution.
That distinction really crystallizes it. So we're talking about incredibly smart, independent digital workers capable of making contextual decisions. What happens then when these digital workers start collaborating? Does the magic truly amplify?
It absolutely does. That's where the real power of agentic AI truly amplifies. When you have multiple specialized agents working together, you get what are sometimes referred to as multi-agent systems, or AI swarms, or even digital factories. These are complex ecosystems where different agents, each with their own specialized skills, collaborate seamlessly to solve larger, more intricate problems that a single agent or human couldn't manage efficiently alone.
Like a digital team.
Pretty much, yeah. Typically in such a system, an orchestration or supervisor agent directs the overall workflow. It assigns specific tasks to various subagents, manages the flow of information between them, and synthesizes their individual outputs into a cohesive solution. Let's take a practical example from financial services. Continuous Know Your Customer, or KYC, maintenance. This is a critical, ongoing process for banks to verify identities and assess risk.
Right, very important for compliance.
Exactly. Imagine a multi-agent system tackling this. You could have a research agent tasked with autonomously pulling public source data on a corporate client, continuously monitoring for changes. This data would then be passed to a risk-scoring agent, which analyzes it against predefined criteria, updates the client's risk profile, and potentially flags any suspicious activity or changes in their background. Finally, a reporting agent could then autonomously generate and file any necessary regulatory updates or compliance reports based on the risk-scoring agent's findings.
And all without human handoffs.
That's the key benefit here, seamless collaboration. These agents pass information between each other without the delays and potential for human error associated with manual handoffs. This not only reduces operational friction and processing times, but also creates a complete, immutable audit trail for every action and decision, which is vital for regulatory compliance. This capacity for AI-to-AI collaboration is precisely what enables the automation of complex, cross-functional business processes throughout the financial services industry.
So the fundamental insight is moving beyond just automating tasks to autonomously managing entire workflows.
Exactly. That's where you unlock unprecedented levels of efficiency and accuracy.
And the impact, when we look at the numbers, is quite remarkable. Our deep dive into the material is full of tangible examples and hard numbers showing how agentic AI isn't just theory. It's already delivering significant returns for financial institutions. Let's start with a crucial area for any financial institution: security and compliance. How are agents changing the game in fighting financial crime? Beyond the raw numbers, what's the fundamental shift in strategy this enables for banks?
It's truly revolutionary in the fight against financial crime. Think fraud detection, anti-money laundering, AML, just preventing illicit financial activities, and KYC. We're seeing a fundamental shift from reactive, static, rule-based systems to proactive, continuous surveillance. Historically, fraud detection relied on predefined rules, which meant criminals could often find new ways around them.
Always playing catch-up.
Right. Agentic AI changes this by having intelligent agents continuously monitor transactions, user behavior, device data, and network patterns in real time. Crucially, they identify not just known fraud signatures, but also novel anomalies and emerging patterns that static rules would simply miss, often learning from new threats as they appear.
So they can spot things no one's even seen before.
Potentially, yes. Upon detecting a credible threat, these agents don't just generate an alert. They can execute a series of autonomous actions within predefined parameters, such as temporarily blocking a suspicious transaction, freezing an account, or escalating the case to a human analyst with a pre-populated investigation file already prepared. This dramatically reduces the time between detection and response.
And the results are measurable.
Very much so. The quantifiable impact here is compelling. The material we've examined shows up to 30% faster fraud detection and a reduction in false positives by as much as 50%. One global financial institution even reported fraud detection accuracy improvements of 20–40%, with some institutions reducing false positives by up to 95%. That's huge.
Wow, 95%. That's incredible.
It is. And even more concretely, HSBC reported detecting 2 to 4 times more suspicious activity while simultaneously cutting the volume of incorrect alerts by 60%. This frees up their human investigators to focus on the highest risk cases.
So it's not just faster, it's smarter targeting too.
Exactly. The real insight here isn't just about speed. It's about shifting the entire security paradigm from reactive defense to a continuously learning predictive offense, fundamentally rewriting the rules of engagement against financial crime.
Are there specific examples of banks using this now?
Yes, we have real-world examples. PayPal, for instance, leverages agentic AI for continuous real-time fraud monitoring across its vast transaction volumes. Nasdaq Verifin, a leader in anti-financial crime technology, is integrating agentic capabilities to automate the dispositioning of lower-risk AML alerts and to manage entire enhanced due diligence (EDD) reviews, which involve a deeper level of scrutiny for higher-risk clients, including autonomously searching for adverse media and analyzing historical activity.
So automating some really complex compliance tasks.
Precisely. We also see one global bank successfully implementing an agentic AI factory to handle its end-to-end KYC workflow, significantly reducing manual hours and creating an immutable audit trail for every decision made by the agents. This transforms customer onboarding from days to minutes while maintaining regulatory compliance.
That's a powerful shift in the security paradigm. So, if agents are brilliant at defending against the unknown, how are these intelligent agents creating new opportunities and competitive edges in the dynamic world of capital markets, from high-frequency trading to managing investments?
Capital markets.
Yes.
In that fast-paced world, agentic AI is truly a game changer, moving beyond traditional algorithmic trading to a much more dynamic and adaptive form of automated decision-making. We're talking about trading bots that are no longer constrained by fixed, pre-programmed strategies.
Moving beyond the simple algos.
Exactly. Instead, they operate with a high-level, goal-oriented objective, something like maximize profit within a specific risk tolerance, or execute a large order with minimal market impact. To achieve these goals, they autonomously analyze a vast array of inputs in real time. This includes live market data, broad economic indicators, breaking geopolitical news, and even social media sentiment.
Sentiment analysis, too. Interesting.
Yes, based on this holistic analysis, they can devise and execute complex trading strategies, constantly adapting their approach as market conditions evolve. This also extends to wealth and asset management, where we're seeing the emergence of next-gen robo-advisors. Unlike their predecessors that might rebalance portfolios on a fixed schedule, these intelligent agents can act dynamically.
Continuously optimizing.
Exactly. They continuously monitor a client's portfolio in the context of market movements, identify opportunities for tax loss harvesting, or even adapt to changes in the client's stated financial goals or life events. This allows for a far more responsive and tailored approach to investment management, shifting from periodic adjustments to continuous optimization.
Who's actually doing this? Are there big names involved?
There are compelling real-world examples. Goldman Sachs has integrated agentic AI into its trading platforms for autonomous market trend analysis and trade execution. Then you have quantitative hedge funds like Two Sigma, which manages approximately $60 billion in assets, showcasing the incredible scalability and long-term viability of AI-driven trading strategies.
60 billion.
Wow, indeed. There are also fascinating emerging platforms like the Stonky Project, which illustrates multi-agent trading. It uses an orchestration agent to coordinate specialized sub-agents, a market scanner, a social media agent, a news analyzer, and contextualizes their inputs based on a user memory module that stores the individual trader's risk profile. It's quite sophisticated.
So multi-agent systems in trading too. What about productivity for, say, analysts?
Great question. Beyond trading, these systems deliver significant productivity gains. An analysis by Moody's of its AI-powered research assistant found that users consume 60% more research while reducing the time required for task completion by 30%. What's more, over 90% of those AI interactions were focused on high-value analytical tasks, meaning analysts were spending less time on routine data gathering and more time on actual insights.
Freeing them up for the actual thinking part.
Precisely. The fundamental insight here is that agentic AI is not just about faster trading. It's about enabling continuous real-time strategic adaptation in complex markets, moving firms from reacting to market shifts to proactively shaping their response.
It's clear that real-time strategic adaptation is a huge advantage. Now, moving to a critical function, risk management is, of course, the backbone of finance. How is agentic AI transforming it from what has often been seen as a reactive burden to a proactive, continuous advantage?
You've hit on a crucial point. Effective risk management is absolutely non-negotiable in finance, and agentic AI is profoundly changing its nature. The shift is from labor-intensive static models to continuous real-time operations across various risk domains. This fundamentally redefines how institutions perceive and manage risk.
So it's always on, always watching.
Essentially, yes. Take credit risk, for example. Instead of periodic reviews, AI agents can continuously evaluate a borrower's financial health and solvency by integrating real-time data from multiple sources, dynamically adjusting risk models as new information becomes available. For treasury operations, agents can automate intraday liquidity management, continuously forecasting cash needs and autonomously executing low-risk funding moves to optimize capital.
That must help avoid shortfalls.
Exactly. And critically, for regulatory compliance, agents can act as a tireless digital workforce, monitoring millions of transactions and all system activity against a vast, evolving library of regulations 247. They can automatically flag potential violations, generate alerts, and compile audit-ready reports, transforming compliance from a periodic, backward-looking exercise into a continuous automated process.
That sounds much more efficient. Are there results to show for this yet?
The promising results from early adopters are already clear. Upstart, a fintech lender, uses AI in its underwriting models. This has enabled the company to approve 27% more loans than traditional models, while simultaneously offering those approved borrowers 16% lower average annual percentage rates, APRs. This demonstrates a greater capacity to accurately price risk.
Better approvals and lower rates. That's a win-win.
It certainly suggests better risk assessment. In the area of autonomous liquidity management, ALM, pilot programs in banks show a 25% reduction in liquidity shortfall events, which is a significant operational improvement.
And the bigger picture, what's the potential financial impact overall?
Looking at the broader financial impact, analysis suggests that banks successfully embedding AI across their core risk and decision-making functions could achieve a 20% or greater increase in capital efficiency and a 30% to 50% reduction in credit losses over time. Those are not marginal gains.
No, definitely not.
The core insight is that agentic AI fundamentally improves the financial health and stability of institutions by making risk management a truly continuous, proactive, and predictive capability.
That's a dramatic transformation for risk management. Now, customer expectations are sky high, driven by experiences in other industries. Can banks truly deliver hyper-personalized service at scale, or is this still a pipe dream given the complexity of financial products and regulations?
It's no longer a pipe dream. Agentic AI is making hyper-personalized service at scale a reality. The solution lies in creating intelligent financial partners that evolve far beyond the limited capabilities of simple chatbots. These systems move beyond merely answering customer queries to autonomously acting on recommendations within user-defined parameters.
Like what kind of actions?
Well, imagine an agent monitoring your spending and account balances, then proactively suggesting a balance transfer to a lower interest card before you incur an overdraft fee. They can also tailor their communication style based on your inferred financial literacy, offering a simple visual explanation of interest to a novice borrower or a detailed amortization forecast to a more sophisticated client.
Adapting the communication. That's smart.
And in some cases, customers can even delegate low-risk decisions, such as optimizing savings allocations or adjusting payment settings, directly to their personal AI agent.
Giving the AI some control, within limits. Are banks actually using this level of service?
We've seen several leading institutions deploy these capabilities with significant impact. Bank of America's virtual assistant, Erica, is a testament to the technology's scalability. Having successfully handled over 2 billion customer interactions for more than 42 million clients, with most requests resolved in under 44 seconds.
2 billion interactions. That's massive scale.
It is. The fintech Bud Financial has developed an agentic solution specifically aimed at improving financial wellness, with its agent proactively managing customer accounts to prevent overdrafts, helping low-income customers save an average of $460 each. And Capital One's Chat Concierge demonstrates the power of multi-agent systems in a customer-facing role, assisting customers with the complex car buying process by having different agents collaborate on tasks like comparing vehicle specifications, finding local inventory, and scheduling test drives.
So it helps with complex decisions too. What's the impact on customer loyalty and the bank's efficiency?
The impact on loyalty and efficiency is clear. One study found that banks enabling autonomous services for their customers see 20–30% higher product retention rates, indicating these services create stickier customer relationships.
Right.
Bank of America further reported a 45% reduction in average resolution time and 25% operational cost savings attributable to its Erica platform, showcasing the dual benefits of enhanced customer experience and increased efficiency.
Better experience, lower costs. Makes sense.
The profound insight here is that agentic AI allows banks to move from simply serving customers to truly partnering with them, delivering highly relevant and proactive financial guidance at scale, fostering deeper trust and loyalty.
Those are some impressive individual wins that really highlight the potential. But zooming out, what does the overall picture look like? Are we talking about marginal gains across the board or a fundamental shift in profitability and operational models for financial institutions?
We are definitely talking about a fundamental shift, not just marginal gains. The strategic value of agentic AI becomes incredibly clear when you look at the consolidated impact across various financial domains. The data from early deployments presents a compelling business case, demonstrating significant returns across the board in efficiency, cost reduction, risk mitigation, and even revenue enhancement. It's not just an improvement, it's a reimagining of financial operations.
Can you summarize some of those key numbers?
Sure. Across the board, we're seeing overall operations up to 30% cost savings and 20% revenue growth. Loan processing times cut by up to 80%. Back office operations,
Yeah.
up to 90% of routine reconciliations automated. Financial close, up to 41% faster with 95% fewer reconciliation errors.
80, 90%. Those are huge efficiency gains.
They are. And in risk and customer service,
Mm.
fraud detection, accuracy improvements of up to 300% with a 60% reduction in false alerts. Some institutions even report 95% reduction in false positives.
Mhm.
Customer service, 25% cost savings and a 45% reduction in resolution time. Customer retention, 20-30% higher product retention rates for customers using autonomous services.
So what's the overall return on investment looking like?
When you look at the overall picture, the average ROI multiple reported across various implementations stands at an impressive 3.4x.
3.4 times. Not bad.
Not bad at all. The fundamental shift in profitability comes from the ability to automate entire cognitive supply chains. In finance, many critical processes like loan origination or KYC reviews are not single tasks, but complex workflows involving a sequence of information gathering, analysis, decision-making, and action. Traditionally, these steps are filled with human handoffs.
Which means delays and errors.
Exactly. An analyst receives data, performs a task, then passes it on. These handoffs are the primary source of delays, errors, and operational friction. Agentic AI, especially through multi-agent systems, can manage this entire flow autonomously. By eliminating the friction of these cognitive handoffs, agentic AI doesn't just make each step more efficient, it creates a compounding effect that dramatically reduces the end-to-end cycle time of the entire process.
Ah, the compounding effect. That makes sense.
This is why the most compelling returns on investment are found in these complex, multi-step workflows, suggesting that financial institutions should prioritize these areas for initial agentic AI deployments to achieve the most transformative impact.
Those kinds of numbers and the idea of automating entire cognitive supply chains are incredibly compelling. But with any powerful new technology, there's usually a hype cycle, a gap between promise and reality. What does the available research tell us about separating fact from fiction when it comes to agentic AI? Is there a dose of skepticism we should bring to the table?
That's an extremely important question, and yes, a healthy dose of skepticism is absolutely warranted. While the potential is immense, there's also a significant amount of caution in the market. Let's start with a necessary dose of realism from firms like Gartner. They've issued a stark forecast predicting that over 40% of agentic AI projects will be canceled by the end of 2027.
40% canceled. Why?
It isn't due to flaws in the core technology necessarily, but more to issues in its application and implementation. Organizations are often underestimating the true costs, complexity, and risks involved in deploying agentic AI at an enterprise scale. Many current projects, according to Gartner, are early-stage experiments or proofs of concept that simply lack a clear business case or a viable path to production.
So lots of experiments, but not necessarily translating to real value yet.
That seems to be the case for many. This cautionary outlook is reflected in the broader market sentiment. A Gartner poll of over 3,400 technology and business leaders in January 2025 revealed a market that's more hesitant than the headlines might suggest. While 19% of organizations reported making significant investments in agentic AI, a much larger cohort of 42% described their investments as conservative. A further 31% have adopted a wait-and-see approach or were unsure of their strategy.
So a lot of caution out there.
Exactly. This indicates widespread uncertainty about the technology's immediate value and readiness for widespread deployment. The profound insight here is that enthusiasm must be tempered with realism and a clear understanding of the heavy lifting required for successful implementation.
So if there's so much caution but also so much buzz, I can imagine it's incredibly hard for firms to even find genuine agentic solutions among all the noise and marketing spin.
Yeah.
Is agent washing a real concern?
It absolutely is, and it's a significant problem in the market right now. Agent washing is where many vendors are simply rebranding their existing products, whether they're older AI assistants, traditional chatbots, or even robotic process automation platforms with the shiny new Agentic AI label.
Even if they don't have the core features.
Exactly. They do this despite these products lacking the core capabilities of autonomous planning, reasoning, and tool use that truly define agentic systems. I've personally seen countless pitches where companies just slap agentic AI on their old chatbot. It's like putting racing stripes on a bicycle and calling it a sports car.
Ah, good analogy.
This marketing tactic creates a noisy and very misleading landscape for financial institutions genuinely seeking to procure agentic solutions. According to Gartner's analysis, out of the thousands of vendors now claiming to offer agentic AI, only an estimated 130 actually provide solutions with genuine agentic features.
Only 130 out of thousands.
That's the estimate. And Nushri Verma, a senior director analyst at Gartner, specifically notes that most agentic AI propositions lack significant value or return on investment, as current models don't have the maturity and agency to autonomously achieve complex business goals or follow nuanced instructions over time.
So how do firms cut through that hype? What should they be looking for?
This reality means that financial leaders must develop a highly sophisticated framework for evaluating vendor claims. You can't just rely on marketing materials. You need to ask critical questions. Can the system autonomously break down a high-level goal into a multi-step plan? Can it dynamically select and use external tools via APIs to execute that plan? And crucially, can it learn from its outcomes and adapt its strategy without being explicitly reprogrammed? These are the foundational capabilities that truly differentiate genuine agentic platforms from those simply agent washing their old solutions.
That agent washing analogy really brings it home. It sounds like even when a firm does find a genuine solution and gets a pilot project right, scaling it up to an enterprise level seems to be a huge hurdle. McKinsey calls this almost a paradox with generative AI. What's holding firms back from seeing the material impact at scale?
That's a very astute observation, and it highlights one of the most significant challenges, the pilot to production chasm. McKinsey and Company refers to this as the Gen AI paradox. While nearly 8 out of 10 companies have deployed generative AI in some form, a similar percentage report no material impact on their earnings.
8 out of 10 using it but not seeing the benefit? That's striking.
It is. And this gap between experimentation and value realization is particularly acute for agentic AI due to its inherent complexity and the deeply embedded nature of financial operations. Several key barriers contribute to this problem. First, there are fragmented initiatives. Many firms approach AI use cases in a bottom-up ad hoc manner within individual business units. This leads to a proliferation of disconnected micro-initiatives, a dispersion of investment, and limited coordination or strategic alignment at the enterprise level.
Lots of little projects, no big strategy.
Pretty much.
Okay.
Second, we see technical and talent gaps. Organizations often invest heavily in data scientists to build AI models, but they lack the critical MLOps engineers needed to industrialize, deploy, and maintain those models in a production environment. It's like building a prototype car, but having no one who knows how to mass produce or service it.
Good point. Need the whole life cycle covered.
Third, siloed AI teams are a common issue. AI centers of excellence are great for prototyping, but they often operate disconnected from core IT, data, and business functions. This leads to solutions that are difficult to scale due to poor integration with enterprise systems and a lack of operational alignment. But perhaps the largest barrier is a failure to reimagine workflows.
Just plugging it into the old way of doing things.
Exactly. The full transformative potential of agentic AI isn't unlocked by simply plugging agents into existing workflows. Instead, it requires a fundamental reimagining of those workflows from the ground up, with autonomous agents at their core. This is a significant organizational change management challenge that goes far beyond a simple technology implementation. This points to a deeper issue, an architectural discontinuity. Traditional software, including RPA, operates on a paradigm of process execution, where the logic is predefined by humans. Agentic AI, however, operates on a completely new paradigm of goal achievement, where the system dynamically generates its own logic and process to reach a desired outcome.
Process execution versus goal achievement, a totally different mindset.
Absolutely. This fundamental difference explains why attempts to force this new goal-seeking paradigm into existing IT infrastructure and governance models often fail. Successful adoption of agentic AI at scale requires not just new technology, but a new operating architecture, what McKinsey terms an agentic AI mesh. specifically designed for orchestrating autonomous agents, managing new classes of systemic risk, and integrating with legacy systems in a controlled manner. It's a profound undertaking.
It sounds like an exciting but incredibly complex undertaking. Beyond the market hype and the challenges of scaling, what are the nitty-gritty technical, governance, and even ethical challenges that firms absolutely have to nail down to make this work responsibly and effectively?
These are indeed the critical obstacles, and they form a complex, interwoven set of challenges that span technical, governance, and ethical domains. Failing to address any one of them can derail an entire agentic AI initiative, and often they're interconnected.
Where do we start? Maybe the technical side?
Let's start with the technical debt anchor. For many established financial institutions, decades of accumulated technical debt are a major impediment. First, there's data quality and governance. The old adage, garbage in, garbage out, is amplified exponentially with autonomous agents. An agent making independent financial decisions is only as good as the data it's trained on and the real-time data it perceives. Poor quality, inconsistent definitions, or immature data governance can lead to flawed decisions, completely eroding trust and compliance.
So data has to be rock solid first.
Absolutely. Robust, high-quality, and well-governed data ecosystems are a prerequisite. Second is legacy system integration. Many large banks still run on mainframes. Integrating modern, flexible, API-driven agentic frameworks with these rigid, often siloed legacy systems is a huge technical hurdle that limits scalability and increases operational risk. Third, there's latency and performance. In real-time applications like algorithmic trading or fraud detection, speed is everything. The computational intensity of deep learning models can create bottlenecks, demanding specialized and optimized infrastructure for low-latency inference. This isn't a nice-to-have, it's foundational.
Okay, so tech debt, integration, performance. What about trust, the black box problem?
Exactly. Next, we face the black box dilemma: explainability and trust. Many sophisticated machine learning models, especially deep neural networks, operate in ways that are simply not easily interpretable by humans. While they might produce accurate outputs, the internal logic that led to a specific decision often remains opaque. This poses a critical challenge in a highly regulated industry like financial services. Regulators and customers demand clear, understandable justifications for consequential decisions: a loan approval or denial, a fraud flagging, an investment recommendation.
You need to know why the decision was made.
Precisely. When an autonomous agent makes such a decision, the inability to explain why it was made creates significant compliance risk and erodes trust. Building systems that can provide clear, human-readable audit trails of their reasoning is paramount, as frameworks like the EU AI Act classify agentic finance tools as high risk, requiring explicit explainability and human controls.
Which leads us to governance and security, I imagine.
It does. Then there's the governance and security frontier. The autonomy of agentic AI introduces an expanded attack surface and new governance questions. For data privacy and security, agentic systems need extensive access to sensitive customer and institutional data, amplifying the risk of a data breach. There's also the threat of new attack types, like prompt injection, where malicious inputs manipulate an agent's behavior, potentially causing it to override safety instructions, execute fraudulent transactions, or leak data.
Prompt injection. Sounds tricky.
It is. This necessitates strong controls to prevent agents from using data for unintended purposes. Regarding accountability and control, a critical question arises when an autonomous agent makes a costly error. Who is truly accountable? Robust governance frameworks are needed to establish clear lines of responsibility, implement strong human oversight, human in the loop or HITL, granular access controls, clear escalation paths for exceptions, and crucially, emergency kill switches to halt an agent behaving unexpectedly.
You need that off switch.
You absolutely do. Finally, perhaps one of the most significant challenges is the ethical minefield of algorithmic bias. AI models learn from historical data. If that data reflects past societal biases, the models will learn, codify, and perpetuate those same biases, often at unprecedented scale and speed.
And this isn't just theoretical, right? There have been real cases.
Unfortunately, yes, this is not theoretical. Consider the Apple Card in 2019, underwritten by Goldman Sachs, which faced allegations of gender discrimination for offering significantly different credit limits to husbands and wives with shared finances. Or Wells Fargo, accused of discriminatory lending where an algorithm assigned higher risk scores to Black and Latino mortgage applicants compared to white applicants with similar backgrounds.
How does that happen even if the algorithm isn't explicitly told to use race or gender?
That's awfully due to the proxy problem. An algorithm might be forbidden from using a protected characteristic like race, but uses correlated, seemingly neutral data points like zip code or spending habits as proxies, replicating historical practices like redlining without ever explicitly mentioning race.
Wow. That's subtle but dangerous.
Very much so. This issue is under intense scrutiny from regulators like the SEC and FINR, and new legal frameworks make bias mitigation an ethical and compliance imperative. That story about the Apple Card truly highlights how these biases can creep into systems. It's a sobering thought, isn't it?
It really is.
And these challenges are not isolated. They form a deeply interconnected Gordian knot of risk. Flawed data leads to biased decisions which lack explainability, leading to regulatory violations and an accountability vacuum. This necessitates a cross-functional governance body including tech, data science, risk, compliance, legal, and ethics experts from the very inception of any agentic AI initiative.
That's a comprehensive and, frankly, a bit daunting overview of the challenges, but the opportunities remain significant. So for financial leaders, how do they navigate this complex landscape? What are the strategic imperatives for successfully and responsibly adopting agentic AI, turning these hurdles into stepping stones?
Given the complexity and stakes involved, financial institutions absolutely need a strategic, disciplined, and holistic approach. The days of simply experimenting with new tech are over. This requires deep structural change.
Where should they focus first?
The first imperative is a compliance by design mandate. In an industry as heavily regulated as finance, compliance cannot be an afterthought. It must be embedded from the start. This means shifting from reactive audit-based compliance to a proactive approach.
Building it in from the ground up.
Exactly. Key actions here include establishing clear autonomy boundaries, defining precisely what decisions an agent can make independently and when it must escalate to a human. Institutions also need to define risk tiers for different agentic tasks, applying more stringent oversight to high-stakes functions like customer interaction or critical infrastructure versus low-risk internal optimizations. Auditability must be a core design principle, ensuring immutable logging of every action, decision, and data point an agent uses, creating transparent and verifiable trails for internal and external auditors.
And working with regulators.
Absolutely. Proactive engagement with regulators is essential to help shape the future frameworks for these powerful systems, rather than waiting for rules to be imposed.
That makes perfect sense. Build compliance in from day one. Now, the robots are taking our jobs narrative always comes up with AI. What does agentic AI really mean for the human workforce in finance? Is it about mass displacement or a fundamental change in how people work?
That narrative is understandable, but the reality with agentic AI is far more nuanced and, frankly, more empowering. Agentic AI is designed to augment human capabilities, not lead to a wholesale replacement of the workforce. It fundamentally reshapes roles, shifting the focus from routine task execution to high-level strategic oversight.
So augmentation, not replacement. Do the numbers back that up?
The material indicates that while up to 11% of traditional banking roles might be automated, AI-related roles have actually grown by 29%. And employee satisfaction scores rose by 16% in banks with successful AI-human collaboration. We've even seen over 420,000 employees globally retrained to work alongside AI tools.
That's significant retraining.
It is. The core insight here is that the future of work in finance is not human versus AI, but human with AI.
So what kinds of new roles are emerging?
This means new professional roles are emerging. We'll see human-in-the-loop, HITL, decision makers, who act as essential arbiters for the most complex, ambiguous, or high-stakes decisions that agents are programmed to escalate. These individuals apply nuance, judgment, and contextual understanding that machines still lack. Then there are AI trainers and auditors, a new class of roles focused on supervising agent performance, providing feedback for model refinement, and actively auditing agent decisions for accuracy, fairness, and bias.
Training and auditing the AI makes sense.
And finally, human professionals will become strategic advisors. Freed from the time-consuming tasks of data gathering and routine analysis, they can concentrate on higher-value strategic work. Deep analysis of agent-generated insights, complex problem-solving, long-term planning, and critically, building and maintaining client relationships where human empathy and trust remain paramount.
That paints a much more collaborative picture for the future workforce. So if a financial institution is ready to move forward, how do they actually begin? What's the practical, actionable roadmap for deployment, moving from those initial cautious steps to successful, scaled implementation?
It's not a simple one-off implementation. It requires a pragmatic and phased roadmap. The first step is to set a clear strategy. AI initiatives must be tightly aligned with core business objectives, whether that's improving efficiency, enhancing customer experience, or strengthening risk management. Use cases should be prioritized based on clear business value and technical feasibility, not just hype.
Strategy first. Then what?
Second, you must build a foundation. A robust and well-governed data ecosystem is a prerequisite. Institutions must invest in cleaning, standardizing, and centralizing their data assets, as a solid data foundation is the bedrock for any trustworthy AI. Third, start small and prove value. Don't attempt a big bang transformation. Begin with a small number of high-value, lower-risk use cases, such as transaction reconciliation or internal compliance monitoring. These pilots build confidence, demonstrate tangible ROI, and allow you to refine governance models in a controlled environment before expanding.
Crawl, walk, run.
Exactly. Fourth, adopt a phased rollout. Full autonomy should be the end goal, not the starting point. Initially, an agent might operate in suggestion mode, providing recommendations for human approval. As trust grows, it can move to semi-autonomous, executing actions but requiring human confirmation. Only when thoroughly validated and within well-defined low-risk contexts should full autonomy be granted.
There's stages of autonomy. Makes sense.
Fifth, measure relentlessly. Continuously monitor key performance indicators, operational metrics like task completion time and error rates, financial metrics like cost per task, and the frequency of escalations to human supervisors. This data provides the crucial feedback loop for optimization. Sixth, engage strategic partners. The data suggests that organizations partnering with AI solution providers deliver projects 40% faster, completing deployments in 11 months versus 20 months for in-house development.
Partnering can speed things up significantly.
It often does. Finally, and critically, implement robust risk management frameworks. This means establishing comprehensive governance, including algorithmic auditing, bias testing, model risk management, and clear accountability before scaling deployments. This is the only way to ensure responsible and sustainable adoption.
That's a really clear, actionable blueprint for getting started. Now, looking further out, beyond just operational improvements, the sources we've explored hint at a much more profound disruption. What does agentic AI mean for the very structure of financial markets and the traditional bank-customer relationship? Are we talking about an existential shift?
We absolutely are. This is where the long-term systemic impacts of agentic AI truly come into focus, and they are profound. We're talking about a fundamental disruption to core business models. One of the most significant impacts will be the end of the inertia dividend.
The inertia dividend, what's that?
Traditionally, banking profits have relied on a concept called the inertia dividend, profits generated from customer inaction or a lack of optimization. Most customers don't have the time or information to constantly search for the highest yield savings account, the lowest rate loan, or the credit card with the best rewards. Banks have captured the margin created by this friction.
Okay, so profiting from customers not optimizing.
Exactly. The rise of personal financial agents, PFAs, acting autonomously on behalf of consumers will systematically dismantle this. A customer's PFA will continuously monitor the entire market, autonomously sweeping idle cash into the highest yield savings account, identifying better loan refinancing opportunities, and dynamically switching spending between credit cards to maximize rewards.
So the customer's own agent will do the optimizing for them.
Precisely. This creates a state of perfect and frictionless competition, which will severely compress the net interest margins and interchange fees that have been the bedrock of retail banking profitability. This will lead to an inversion of the bank-customer relationship. The traditional power dynamic, where the bank held the informational and operational advantage, will shift.
The customer's agent holds the cards.
In the agentic future, the customer's personal agent will hold that advantage, equipped with perfect market information and the ability to execute transactions instantly and tirelessly. The bank will no longer be marketing to a relatively passive human customer. It will be competing to have its products selected by a hyper-rational, perfectly informed, and ruthlessly efficient software agent. In this new world, the customer's primary relationship might even be with their own AI agent, and the bank risks becoming a commoditized utility provider that must offer the mathematically optimal product simply to win the agent's business.
Commoditized, that's a scary word for banks. So how do they survive? What are the new business models?
This existential threat will force a shift to new business models. Competitive advantage will no longer be derived from brand loyalty or a physical branch network, but from two potential sources, either providing value-added advisory services that are too complex and nuanced for agents to replicate, or becoming a platform of choice for agents, offering the most efficient, secure, and developer-friendly APIs and infrastructure for autonomous systems to transact upon.
Be the best advisor or the best platform for the agents.
That seems likely. In capital markets, the proliferation of increasingly sophisticated autonomous trading agents will likely accelerate market efficiency. However, it also introduces new and unpredictable systemic risks. The possibility of thousands of agents, potentially trained on similar data or using similar models, reacting to a market event in microseconds could lead to synchronized herd behavior or flash crashes.
Like automated herd behavior. That sounds risky.
It could be. The complex emergent interactions between multiple autonomous systems operating at machine speed could create cascading failures that are difficult for human regulators to predict or contain. The long-term stability of financial markets will depend on developing new forms of regulatory oversight designed specifically for an ecosystem dominated by autonomous agents.
What a journey. We've covered everything from the fundamental definition of agentic AI to its real-world impact across financial services, the challenges of implementation, and even how it might completely rewrite the rules of banking and our relationship with money itself.
If we connect this to the bigger picture, the deep dive into agentic AI reveals a future where financial institutions will either embrace autonomy thoughtfully and strategically or risk being outmaneuvered by hyper-efficient, agent-driven competition. It's about balancing innovation with robust governance and recognizing that the technology isn't just about doing things faster, but doing entirely new things in entirely new ways and at an entirely new scale. This raises an important question.
Go on.
As agentic AI matures and personal financial agents become ubiquitous, how might the very concept of financial loyalty change? And what new forms of value will emerge when every transaction and decision is optimized by an intelligent, autonomous agent on your behalf?
That's a powerful thought to leave you with, isn't it? Something to ponder as you think about your own financial future in this rapidly evolving landscape. We hope this deep dive has given you a shortcut to being well-informed on this incredibly important topic. Until next time, keep learning, keep questioning, and keep exploring.